In this video, I'm going to talk to you about the Be Your Own Bank investment strategy. Typically, this strategy is talked about in connection with using life insurance policies. I'm going to explain to you how that strategy works, and I'm going to tell you why I don't like that strategy and why I think it is in a lot of cases actually a scam. I'll then show you a good way to use this strategy in a way that's not talked about by life insurance agents or financial advisors. There are ways to be your own bank in a way that can give you great tax and investment benefits. So I'll make sure you understand the wrong way to use this strategy, why I don't like that strategy, and how you can actually use this strategy to your benefit and do this yourself without having to have a third-party life insurance agent or company involved. So let's start by talking about what the Be Your Own Bank strategy is. So this has been around for a really long time, and typically it's talked about in connection with whole life insurance policies. And the way it works is that you loan yourself money instead of getting a loan from a bank or other third party. So let's say I need to get access to capital. Let's say I want to buy a business, or I want to go out and make different investments in uncorrelated assets. Or let's say I just need more cash to pay for my personal living expenses. So if I need a loan, typically you think of going to a bank and getting a loan. Sometimes you might get it as a mortgage on your house, for example, or you might just get some sort of line of credit, personal line of credit, or a business line of credit. So the Be Your Own Bank strategy means that you are the bank. You are going to be both the borrower and the lender. You're both sides of the equation here. So there's a way this has worked in past is with whole life insurance policies. If you've read any of the books about Be Your Own Bank and those type of, variations of this strategy, I've never seen it talked about in a context that wasn't around using a life insurance policy. So the way the strategy works, and I'm going to talk to you about how it works with whole life insurance policies and how the strategy works in practice, and then I'll tell you why I don't like doing this with life insurance policies. But there are ways to be your own bank and use the same strategy that I do like. And that is by using SBLOCs, for example, on stocks or bonds. So I'll show you how we use that strategy. We've been doing the Be Your Own Bank variation of that for years. I've done this personally, and I've worked with a lot of clients in the past to put this in place. But this is really a variation of the buy, borrow, die strategy. So you want to accomplish these same principles that are in this Be Your Own Bank concept where you're both the bank and you're the borrower. So you want to do this in a way that you're using this in connection with the buy, borrow, die strategy. So if you're not familiar with that strategy, I've linked to my video below. Again, that is one of the most important tax planning strategies out there. If you are someone who seriously wants to build wealth and achieve financial freedom, you're going to need to understand how that strategy works, and you're going to need to understand how you can implement it in practice. So I'm going to show you how you can be your own bank with SBLOCs, and I'll talk to you about what SBLOCs are and how that can work if you're someone who invests in something like stocks or bonds. So to start with, I want to tell you about the traditional view of how this strategy works. So I'm not going to dive into the specifics around life insurance and the different policies out there, but basically you want to use a whole life insurance policy. That's the way this is done. You go to a insurance company that offers these whole life policies. Step one is you get the policy. So you put the policy in place. You're going to pay annual premiums for a number of years. So some cases you may pay those premiums in perpetuity, but in a lot of cases you're only paying them for a couple of years. You might pay, 5-6 years of premiums. And I've seen people use what's called premium financing to do this, where maybe you make one payment and the rest is financed. That's definitely something you would not want to do in the current environment where we have high interest rates. But there's different ways that you can structure these policies. But for all intents and purposes, what you're doing is you're getting a whole life insurance policy and you're paying annual premiums. Typically, those premiums are very high. So you might think of, when you typically think of life insurance, you might think of getting a term insurance policy, which is really only, a couple thousand bucks a year. But with these whole life insurance policies, you're going to typically want to stuff a bunch of money in there if you're doing this. So you may be paying premiums of $25,000, $50,000, some cases $100,000. So the premiums are much higher than you're typically going to think about with other life insurance policies. The next step in the way this works is that you wait a couple of years as you build up a cash value in the policy. So in short, and I know I'm oversimplifying this, but the way it works is that the first year you pay in your premiums, a large portion of that goes to, fees and other premiums, payments to the life insurance company, maybe to the agent who helped you negotiate the policy. So you're going to lose a lot of that in the first couple of years to that, but you're going to start to build up a cash value inside the policy. And that cash value is really yours. You would get that as a death benefit on top of potentially some other benefits. But when you die, that cash value would be paid out to whoever the beneficiaries are of the policy. So what you want to do is let those premiums sit for a while, keep paying them in, build up a cash value inside the policy. Then once you have a significant cash value in there, you're going to borrow against your own life insurance policy to then use those funds for whatever you see fit. So it doesn't matter really what you're using those funds for in most cases. It can be personal, it can be to invest in other assets. The way I see this touted a lot is that you get a whole life insurance policy, you get an index policy where maybe the cash value is invested in and tracks an index fund like an S&P 500 index. And so that money is invested and growing over time, hopefully. Plus, you get to then borrow against that and invest in something else. So I see a lot of people do this where they think they're double dipping and investing the same money. So I might have money invested in an S&P 500 index fund within that policy. I borrow against it and I invest in a real estate fund or real estate syndication. So that's the way, if you hear someone talk about this on a podcast or an agent that's trying to tell you the great benefits of this. So that's the way they're going to explain it to you. So you're basically double dipping the same money, which I'm typically a big fan of that strategy. If, that is the buy, borrow, die strategy. And one of the many reasons that's a very powerful investment tool. But I'm going to talk to you about why I don't like it in this case. So for starters, there are other ways to accomplish these same objectives without having to pay fees, without having to deal with insurance agents, without having to deal with a life insurance company. There's all kinds of issues that I'm not even going to touch on with these types of policies and how they work. But what I want you to understand is that there is a better way to accomplish the same strategy with more efficiency because you're not paying fees and where you can maintain more control. So I'll talk to you about that in a minute, about how the good way to do this. But I want to talk to you about why I hate these. So I have changed my mind on this in practice. I used to think these policies sounded great, and they do conceptually. I love the way they sound, but the problem is that you're going to lose premiums paid to an insurance company. So you've got to pay for the insurance that you're getting. You've got to, there's going to be a piece of those premiums that go to the agent that helped you, get the policy and write the policy. There's all kinds of fees that you're going to pay. What I really, really, really hate about this is that there's no transparency on those fees. It is a huge black box. So I have spoken to a lot of agents about this. I have seen the models. I have modeled this to death myself a number of different times in a number of different ways with all the different types of strategies out there. And I've never been able to make it work. And I cannot ever get a life insurance agent to explain to me and tell me in concrete detail, these are the fees that you're going to lose. These are the fees that you're paying. This is where it's going. So if you can find an agent who's willing to tell you that, then maybe that's a different ballgame. But there's a lot of sleaziness in this space. There is no one selling these policies who does not stand to benefit from it. There is no one out there telling you to do these strategies that does not stand to have some financial incentive motivated behind you getting a policy with them. So when I start seeing really thought leaders in the space who are independent, unbiased like myself, I don't care if you do this because I don't benefit from it or not. When I start hearing people like that, third parties that are unbiased, start to say these are good strategies, then I might change my mind. But I have never in practice heard someone say this is a great strategy that wasn't either a life insurance agent, salesman, or at some point maybe a retired salesman. So that's one of the biggest reasons I hate these strategies is that if I'm going to pay fees, I darn well want to understand what those fees are and who's going to get them. Also, there's very limited flexibility in the investment options within the policy. A lot of whole life policies are really where you're only getting dividends from the life insurance companies. Those dividends are extremely low. I think, that you can think about the way insurance companies invest their money, but the way they work is they pay out dividends to the policyholders in some cases. So those rates of return on those dividends from the insurance companies are very, very low. I think best case scenario, they might be 5% or 6% in a really good year. Yes, life insurance companies, the good ones and the big ones, are solid, conservative. You don't have to really worry about them going out of business because if they went out of business, you lose everything. But if you go with a good company, that's been around for a while, you shouldn't have to worry about that. But I'm not doing anything where I'm only best case scenario getting a 5 or 6% return. That's just not something I'm interested in investing in. I have much better investment options that I have more control over. I don't have to pay someone a fee to do. So I'm not going to do that. Also, there are some policies that let you do index. So like I mentioned, the S&P index tracking, you are limited on that. Yes, they try to say, oh, you're not going to lose your money because we put a floor on how much you can lose. But there's also a ceiling on how much you can gain. So you never get the returns that they say you're going to get. I've talked to a number of people who have done these policies in the past. You're going to get, an agent that says this is the percentage of return you're going to get every year on average. I understand from people that have done this, nobody has ever achieved that every year. So I don't know what's happening with how they're doing it. Again, it's a black box, but you are not getting the full return. So you're much better off investing in an index fund, an S&P index fund outside of a life insurance policy where you can get the full amount of returns. People like to have these floors. For some reason, it makes them feel better. The S&P has never, yes, it drops. Yes, it's volatile. It has never in history not come back and come back higher than it ever was. So if you're someone that's going to invest with some doomsday, attitude that the stock market may drop and just never recover, then, maybe this is something for you. But I'm much more of a long-term bull. I'm much more of focusing on history. The stock market has always come back. So I don't care about some sort of floor on the amount of, losses I can have. I would much rather have the upside potential there, because on average, the S&P has always averaged, 8, 9, 10% over the past, most recent years. So I certainly would want to be able to get that percentage. That's a much more attractive return to me than something that's got some ceiling on it because of the insurance companies. So that in a nutshell, and I know this is a very basic overview of how these policies work. If you are interested, there's a lot of books out there that talk about this. There are a lot of very wealthy people who have done this. So I'm not saying that nobody does this. This is done a lot in practice. I know a lot of really smart people who do this strategy. People talk about this in connection with LIRPs, which is life insurance retirement planning. There are some benefits to the strategy for sure. Like, I'm not going to pretend like it's all bad. I just think overall there are better ways to do this. And I think there's a lot of sketchiness in the space. I also want to mention that I'm only talking about this in connection with the Be Your Own Bank strategy. Life insurance can be used as a great tool. For example, we do estate planning with life insurance. That is a very powerful tax and estate planning tool. So I'm not saying don't ever, use these types of policies or do these types of planning, but I don't like these whole life insurance policies with this Be Your Own Bank strategy. And that is largely because I think there is a much better strategy out there. So if you haven't heard of SBLOCs, these are securities backed line of credit. This is basically where you take a loan from your brokerage account against your stock or bond portfolio. So you're using your stocks or your bonds as security or collateral on a loan. And I'll link to my video below on SBLOCs. If it's something you're not familiar with, you should understand it better. It's a very powerful tool we use in connection with the buy, borrow, die strategy. So check out that video if you want to understand better about SBLOCs, what they are, what the risks are, how to do them in practice. Check out that video. But I'm just going to explain to you really conceptually how to use an SBLOC for this. So typically SBLOCs let you borrow up to 50% of your portfolio of stocks or bonds. I don't invest in bonds. I know a lot of people do. It just goes against my investment philosophy. I would never tell anyone what to invest in and what not to, but I personally use this with respect to public stocks. But I wanted to point out that if you do have bonds, you can sometimes get an SBLOC against that portfolio as well. You can borrow up to 50%. So let's say I have a portfolio of 5 million, public stocks. I can borrow 2.5 million against that. And usually I can do that at a pretty low interest rate to do that. So I typically see the interest rates in line with sometimes mortgages on a personal residence, in a lot of cases lower than what you can get on a mortgage. So it's some of the lowest cost interest rate borrowing you can get access to. What I love about this is you maintain control over the portfolio. So just like I mentioned with the whole life insurance policy where you're investing your cash value within the policy, here you get to keep invested. So if I'm investing in an S&P 500 index fund, I keep invested, I stay invested in that, and I keep getting the upside, gains in that over time. I can then borrow against that and invest in whatever else I want to. So typically we would do that with, uncorrelated assets. You wouldn't take a loan against a public stock and go invest in other public stocks. That would be very dumb. But you can use the same strategy where you are your own bank. So you're here, you're the own bank. You are the borrower, so you're taking the SBLOC. You're the one taking the money. And you're the bank because you're borrowing against your own portfolio and you're lending to yourself essentially against your stocks and bonds. So that's why I like this strategy. It's basically the same in my mind conceptually as the whole life insurance strategy with this. But what I really like about it, you're not paying premiums or fees to anybody. You're going to pay, yes, you're going to pay margin interest. So, you're going to know right up front what that interest rate is. In a lot of cases, it's a variable rate. So yes, it may go up or down, but you're going to know what that is. There's transparency there around what the rates are. They publish them on their websites. It's pretty easy to find. You're not paying any premium or fees to any agent or any company to do these loans and, borrow against your own stocks. There's also, as I mentioned before, very low interest rates available. So if you know how and the right places to go, and check out my SBLOC videos where I talk to you about the best places to do this because you can get the lowest interest rates. Check out that for that because you don't want to, pay. A lot of people do this like with Morgan Stanley or, E-Trade. You would never want to use those accounts there because they have really high interest rates. So you want to shop around for lower interest rates here. Also, there's no limit on the funds. You have 100% control here. You can continue, as I mentioned, you continue to get the upside in your stocks and bonds. You continue to get income, dividends, whatever comes from that. And you can invest in something else. So you can still do that double dipping strategy and you can use the funds for whatever the heck you want to. So if you want to use them for personal expenses, if you want to invest in other uncorrelated assets, you're certainly able to do that. So this is just another variation of the Be Your Own Bank strategy. I like this one much better for a number of different reasons. And I think that, again, I'm not saying that there's never situations where people don't use the whole life insurance policies. I have modeled this and modeled this and modeled this, and I've never seen it not come out better from just a net return standpoint when you factor in the fees and everything else, that you're not better off doing this through the SBLOC strategy yourself, as opposed to going through an insurance company where you have no clue or no transparency on the fees or premiums that you're paying. So again, I hope you found this overview of the Be Your Own Bank strategy helpful. This is kind of a modern take on my own, thoughts around this strategy. I know it's been around for a while, but I think that it's time to kind of think outside the box and challenge that insurance agent, those insurance agents that have kind of gotten away with selling this for a long time without giving us a lot of transparency and explaining exactly how these policies work. And so, hopefully you found this helpful. If you did, please check out our other videos on the buy, borrow, die strategy and SBLOCs and how they work in practice.